There are many misconceptions about DSTs, so today I sat down with a DST advisor to help clarify those. I'm here with Al D. Nikolov, Naples Asset Management Company. Thanks for joining us today, Al. So please tell us a little bit about yourself.
Pleasure to be here. I've been in real estate a long time. I've done a lot of real estate, 1031 exchanges, development work, and mostly in the Naples, Fort Myers area the last 30 years. Here in Sarasota now, happy to meet your acquaintance, to hopefully do some more business together. The 1031s have always been a cornerstone of some of our investors looking at making sure they can defer capital gains and creating wealth over generations.
Okay. Yeah. So obviously, we've spoken a little bit, in some of our other videos and so forth about what a DST is. So here, I kind of want to talk about what are some of the myths and misconceptions about a DST.
Well, you have misconceptions about DSTs. Probably is, how do I get into it? How do I get out of it? And what are they good for? So they're not just a last-minute solution for 1031 exchange when you've run out of time and you've failed to identify a replacement property. I have a lot of investors that do prepare to get into a DST. So one of the myths is that you can only use them as a last minute. Some of the investors are looking at DSTs as it would create a elimination of taxes. Well, it doesn't. It defers taxes.
Okay.
And the tax write-offs with a DST are going to be subject to individual situations. They're not all the same. Even though last year we had a return of 100% depreciation, which some of our sponsors will probably utilize to create additional write-offs, they're not 100% write-offs. Every person is different with that.
Okay.
And the other misconception is I can just simply decide when I want to sell my property. All DSTs have a holding period, typically 5 to 7, sometimes more years, more than that. Some of them have also exit strategies that are 2 and 3 years. So each DST is structured a little bit different on the exit strategy.
Okay.
But the biggest misconception is that they're only for the ultra wealthy.
Right.
People say, well, I can't get into them because,
I'm not an accredited investor or...
Well, yeah, we can handle the accredited investor issue in a moment, but sometimes people think, my exchange is only $200,000 or $300,000. I can't handle that. Now, there are opportunities for people that are not an accredited investor to get into certain Delaware Statutory Trusts, and that has to deal with either a 506B or a 506C, and that's how they're regulated.
Okay.
But there's a limited amount of non-accredited investors that may be able to get into a DST. Depends on what they're looking.
So you kind of touched base on it. So is it true that once I get into a DST, I can't sell or exit early, right? That's one of the big things with the DST is it's up to the sponsor or that trustee at the DST to know when to sell based on when that ends. So I lose control over that.
That's correct. That's correct. That's one of the advantages of being a passive investor. You don't have to worry about management, but also one of the drawbacks is you don't have any ability to manage the property.
Okay.
Excuse me. So yeah, so if you want to get in and out of a piece of real estate within a year or so, you need to be pointed in a different direction than a Delaware Statutory Trust.
Okay. So obviously it sounds like in sometimes what we hear from a lot of 1031 clients, and we bring up about, DSTs being an option for replacement property, option to identify. And, from our end, we talk a little bit high level for it, and they're like, oh, is it like a REIT? So, is it a REIT? Is it not a REIT? Is it like a tenant in common interest? What is the difference there that makes it a DST a little different?
You mentioned tenant in common. So initials TIC. TIC would probably be a better comparison to a DST than a REIT.
Okay.
Because in a TIC, you can do a 1031 exchange out of your property into a tenant in common.
Right.
And then there's nuances between the two because DSTs have non-recourse debts. Most TICs have recourse debt. TICs, you could have 35 investors and DSTs 499. So there's more fractional ability in a DST to get to a institutional grade property than there would be in a TIC. Now the REITs do not qualify for a 1031 exchange. REITs are partnership interests. Now within the last 3 years, I think, some of the exit strategies of Delaware Statutory Trust included the ability to do what's known as an UPREIT. That comes in Section 721 of the tax code. So it's a 721 UPREIT. So we have had, in the case of some of my investors, they purchased a multifamily property 4 or 5 years ago. The value of it went up. And so the sponsor said, hey, we have the ability we're going to sell. So you have the ability to go to a 721 UPREIT, which has advantages, or you could take your cash out and pay your capital gains, or you can do a 1031 exchange into something else. Right. What is that something else? It could be another traditional piece of real estate. You could go and invest in oil and gas and get write-offs there, depending on the time of the year. The 721 UPREIT has the ability to create a diversification pool of assets where I'm leaving a $50 million apartment complex, and now I'm getting involved with a $10 billion REIT that has assets all over the place. So diversification doesn't guarantee that it's going to eliminate risk, but sometimes it does mitigate risk. So those are the items that we look at.
Okay. So obviously, we know the IRS has ruled that DSTs qualify for that like-kind replacement property for a 1031 exchange, where a REIT doesn't. So that's always good, because we always hear that, oh, it's like a REIT, and it's trying to kind of explain to people, no, it's not a REIT, from the internal mechanisms of how it's worked and structured and everything along those lines.
There is an advantage if you are in a REIT, because a REIT can take cash. DSTs can take cash also. That's not the investment, but the REITs, especially if they're publicly traded REITs, you don't have to be an accredited investor.
Right. And
then you have liquidity options. Typically on a quarterly basis, you can request some liquidity. They can peel off units there.
Okay. So do DSTs, do they only invest in one specific type of real estate, or is it something that allows people to diversify out? Because we always hear that, and that's one of the things people are like, well, I'm buying this DST. Is it just one property in that DST, or are there multiple properties? Is it like a portfolio? How's that kind of...
Right. That's a good point. And once again, it goes back to suitability for the investor. What's the investor's goal for longevity? I have some investors that decided they have 3 daughters. They're going to go into 3 different DSTs, and they're going to give each daughter a different DST. I have some investors that do not want to diversify outside of one area because they don't want to have to be subjected to any type of state income tax in certain areas. For example, there are some extremely well positioned necessary retail portfolios that could be located in 9 different states. Wow. They're triple net leases, with bumps every year, 9 different states. Well, your accountant may have to file.
You might have a headache with that one.
Yeah, you may have a headache with it. So you have to take a look at what is the advantage to do that. We have great diversification, great credit tenants, and then you have an accountant that may have to file a small return in Ohio or Illinois, things of that nature. So it all depends on the size. And then it also could depend on some of my investors that are coming out of a $3 or $4 million exchange do want to diversify into multiple. They're coming in an apartment complex. They may say, can you find me a self-storage, a student housing? I want an industrial, and I want a logistics center. So sometimes that really helps. And there's also, we had one that was a very famous football team that's in Las Vegas now. Their training center is a DST.
Wow.
It's on a 30-year land lease, extremely profitable, guarantees from the...
that's guaranteed, yeah, especially...
It's guaranteed,
yeah,
right?
So
the asset classes have, I guess you could say, upgraded. I mean, big logistics companies like Amazon, Ford Motor Company, they are, there's big investments going into Delaware Statutory Trust.
No, all great stuff with that. So you talked about your client who had the 3 daughters. So talk to us a little bit about one of the things like we've always prefaced on with 1031s is that generational wealth building aspect of it, and being able to pass. When people have property, they get that stepped up in basis when they pass. Is that some of the same things that can happen with it? Like what happens a little bit with that?
Yes, and in our advisory firm, we do we interact in our firm, and we will occasionally find someone who was very excited that they sold their real estate and then gave the proceeds to their kids, but ended up paying capital gains on that real estate, which they could have structured differently,
Right.
because the step up in basis is that upon the investor's demise, the heirs get a step up in basis to the current market value. So in the case of this one investor who did it the wrong way, I guess, they owned the property for 30 years. It was fully depreciated. So they had to recapture all the depreciation, and they had to pay capital gains, which probably may have eroded 50% of the profits on the property. So yes, it's a wealth building tool. It's not a tax loophole, which some people think is it's a
Huge misconception. Yeah.
misconception. It's not a tax loophole. 1031 exchanges have been around for over 100 years.
Right.
They've changed a little bit over the time period. End of 2017, they eliminated being able to do a 1031 exchange on your yacht.
Yeah, personal property.
Personal property.
Yeah,
So that's
just real property.
And that's mostly it's all real property. So wealth building from generation to generation. Yes. So that's been a big part of our business, has been, okay, how do I securitize, and not that you're going to buy a security, but DSTs are listed as securities. How do I make sure I can protect the assets that I've accumulated over the years, and then pass it on to my family?
So the family does get a stepped up in basis.
Right,
Their
right.
percentage
The
of-
family will get a step up in basis. Now, I have some investors that are in the Midwest that don't have children, so their bequests are going to go to charities. They've designated certain charities that will get these DSTs when the sponsor decides to sell.
Okay.
So yes, you don't have to just leave them to your family. You can direct them in a charitable trust, in which the trust business is, another big asset that people should look at in their life.
And I think too, if I understand correctly, even if you have multiple children, it's easier to split. Instead of, we have this one real property and now it's going to these three children. You now have to figure out who's doing what with it and how it goes and how it's split. Where I believe with the DST, the percentage share, you could say I want this amount to go here, this percentage of my share.
Yes,
my
you can do
interest.
that. And then some of the Delaware Statutory Trusts that will move into a 721 up REIT may make it a little bit easier, because you can peel off units. If you had $1 million that went from a DST into a REIT, then you could divide that and said, okay, if I have 4 children, each one gets 25% of that REIT.
Okay. So talking about, I hear a lot of the good things and saying, are they recession proof? Are DSTs recession proof, or is it more just on the asset class where you're at that you're investing in determines whether it can be recession proof?
Recession proof investments, I mean, there's very few of them that are recession proof. I think that if you take a look at all real estate, depending on where it's location, and obviously it's location.
Right.
From what I've been told all my life. So certain asset classes may be more recession proof than others. We experienced that during COVID. The first asset class that struggled were hotels.
Right.
You weren't traveling.
Right.
Hotels, I mean, that was a problem. Hotels, they struggled. So how did the industry combat that, or what did they modify? Prior to the COVID, some of the hotels carried leverage 30, 40, 50%, which by design, DSTs have leverage, because in a 1031 exchange, you have to replace the debt.
Right.
But now I would say of the 5 or 8 Delaware Statutory Trusts that are in the hospitality suite are all cash. They're all cash DSTs. So it's a good thing, because you don't have to worry about the mortgage not being paid if people aren't showing up. What does hurt is that for people that really want to buy into a Marriott branded or a Hilton branded hotel that's a DST, that if they have to replace that, they can't get into that because that's an all cash deal right now. So most of the hotels that you're seeing now are all major branded hotels and pretty good locations. So.
Okay. No, so it's all great points there. So you can kind of see the DST is a great way. It allows people, like we said, diversify. but also looking into the leverage side, the operational side of who is that underlying, tenant with that, what's happening. And then obviously depending on market conditions, will kind of dictate where you go and what you're looking for.
Right. I mean, everyone needs a place to live.
Right.
So the apartment complexes, you would think that are, quote, recession proof. But if that certain area relied heavily on one employer, then that
You're looking, that's the risk that comes, right?
And I know we talk about AI, but even in the oil and gas business, technology for drilling has really improved over the last 20 years. And so you may not need as many employees to run a drilling rig. Not that I know everything about land, but
right.
But yeah, so you have to take a look at the geographic area. If the schools are not doing well and there's no job market and you can't get to the apartment complex, I wouldn't say that's very recession.
Okay. No, I appreciate, again, the time coming in, discuss a little bit about the misconceptions and the risk, as well as, some of the common things that people need to know about with that. So I appreciate it. And
there's one final point I can make. For any investors that are out there, they need to contact their QI sooner than later. Because what we found that, if you've already taken the cash and you've taken constructive receiving, though your stockbroker may have it, you're out of luck.
Right.
So, I mean, working with a qualified intermediary really, really is important. Who understands how to make the identification on the 45-day list and keeping the clients impressed. So I appreciate your work.
Absolutely. Appreciate your time again for coming in. Again, Al DiNicola from Naples Asset Management Company. Thank you, Al.
All right. Thank you.
And that wraps up this video. If you have any questions about a DST or 1031 exchange, our contact information is below.